Hello, all you lovely people out there. How is everyone doing? I'm Kate Hill and I am here to give you the best unbiased and honest commentary about our property markets, along with fantastic hints and tips. So stay tuned for a short property news update. Now, new data released recently has confirmed the critical undersupply of rental properties around Australia. According to SQM research, the national residential rental vacancy hit just 1% in March, which is the lowest level in 16 years. The last time national vacancy rates was this low was Kevin 07 wasn't even a thing yet. To understand what this metric actually means, it's critical to know that the equilibrium point of supply and demand in the rental market is generally considered to be 3%. So a vacancy rate of around 3%. This can vary a little, but it's generally what we're talking about. This means that a vacancy rate of 1% is deep within critical undersupply territory. Some cities and major regional areas have vacancy rates of 0.5%. Adelaide has just recorded the lowest vacancy rate ever tracked in a capital city, all of which is just an astoundingly bad situation for renters, great for landlords. The rental crisis actually began more than 5 years ago, in 2017, prior to the last federal election in Australia, way before then. At the time, the Reserve Bank and the financial regulator APRA were concerned about the strong property price growth that had and was occurring in Sydney over that time. Of course, our lovely harbour city real estate is significantly higher now than it was then, but whatever. They were so concerned that they implemented lending restrictions to slow down just that one particular market. The interesting thing, of course, is that these restrictions affect property markets nationwide, markets that weren't even booming. So again, whatever. Not great for Adelaide and Brisbane buyers, for example. Fundamentally, it meant that it was much more difficult for investors to secure finance because of this reduction in interest-only loans, higher interest rates and plug rates, which is the rate at which the bank actually assesses you on investment mortgages. The end result was plummeting investor activity, a situation that stayed like that for 4 years and potentially meant thousands upon thousands of rental properties that were never added to the rental pool. According to CoreLogic analysis, investors comprised nearly 32.6% of mortgage demand by value in January 2022, which was up from the recent record low of 22.9% in 2020, but still below the decade average of 34.9%. If these lending restrictions weren't enough, there was the political mudslinging about negative gearing prior to the 2019 federal election, which kept even more investors on the sideline. You'll remember that the Labor Party took the removal of negative gearing as a policy to that election, a policy that effectively lost them that election. The volume of investor activity kept falling until the first year of the pandemic. Apart from general concern about market conditions and the world ending as we knew it when COVID hit, vacancy rates temporarily spiked in some areas, and it looked like governments were actually asking investors to take one for the team at one stage, allowing tenants to live rent-free in their properties in certain areas. This did not inspire investor confidence. WA was particularly badly affected by this because they kept all the borders closed for so long. It diminished investor confidence in that economy, and they also kept everybody out. Plus, there has been declining dwelling construction and soaring material and construction costs because of supply chain issues. Since the start of COVID, sadly, we have also seen separation and divorce rates rise, which has increased the number of sole person and single parent households. So that is the family who lived in one property now potentially live in two, which further reduces the supply of rental stock. Likewise, owner-occupier buyers still are at record levels over the past year or two, and many have been purchasing properties that were formerly in that rental pool, especially in some of those locations where price growth has been a bit negligible or sluggish for a year or for years. So investors have taken that opportunity to offload some of their holdings as prices are rising, and they were rising. Now, we have the imminent return of hordes of overseas migrants, possibly again coming up to record levels. We need more people. But the question you've got to ask yourself is, where the heck are they all going to live? We're all rental in a critical undersupply. So for all of these reasons, the critical undersupply of rental properties really is a serious situation that is perhaps going to persist for the foreseeable future. And when I say that, I mean probably for the next couple of years, not the next few months. You can only wonder how bad it is going to get before then. So I will keep you posted on all things property from around Australia as our year progresses. We're already at the end of April, who would have thunk it? Don't forget to hit the subscribe and like button if you're enjoying all my free content, and I will see you all soon. Bye.